Purpose of the insurance is to cover the large losses, proper risk management, high liability. Where, as an investor, can I afford to take on risk and then buy that extra couple $1 million of liability or increase the property to replacement cost coverage?
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 150. Today, we're going to talk about an item that every rental property owner has, but many of us don't really think about it or understand it until something bad happens. I'm talking about your rental insurance policies. There are many ways to protect yourself properly, and there are many ways to make mistakes that will cost you money if the time ever comes when you need to cash in on that insurance policy. So I've invited my insurance broker, Mike Murphy from JB Harrison Insurance Agency, to talk about the common problems and mistakes that he sees investors making on their insurance policies. Mike, welcome to the show.
Thanks, Brian. Great to be back with you.
Yeah, thanks for being here. Now, there's a couple things I want to point out in the beginning. One is that you are providing the insurance policies for all of my residential properties, from commercial to residential, duplexes all the way up to 207-unit apartment complex.
Yep.
The other thing I want to make clear is that you are a broker, so you don't represent just one company. You can bring multiple insurance companies to people.
Yes. As an independent agent, we have choices for our customers. We work with all highly rated A+ rated companies. When I say A or A+ rated, I mean their financial strength. Having choices lets us find the best company for the insured, not the company fits everybody, because that's all we have. Having options is always a benefit to our clients to serve their needs the best.
So, Mike, I know that you have some stories and experiences from you being in business for how many years?
13 plus.
13 plus. So you've seen it all.
I've seen enough.
You've seen enough. Why don't you give us some examples and then tell us what mistakes were made along the way and how that investor could have done it differently?
Sure. I had an investor last year, actually, fairly large portfolio, just to lay it out there, had duplexes, single families, multifamily apartment community. So just a blend of everything. Really nice client. There were inconsistencies from location to location. Coverages didn't line up. And ultimately, there was a claim going on right as we were trying to take over the account that really reinforced what we were trying to do. And I'll lay that out here in a minute. So this investor had his insurance policies through another agency or agencies. Yep.
And what kind of inconsistencies did they have?
Well, it really came down to buildings with replacement cost coverage, buildings with actual cash value coverage, different deductibles, different liability limits, and a lack of understanding with how that policy responded to claim time.
They were trying to switch over to you, kind of putting a policy in place that would accommodate all these properties. And what happened?
There was a loss on an apartment unit, and after the deductible was paid, there was not nearly enough money from the insurance provider to cover the loss because it was insured on actual cash value, meaning there was a whole list of depreciated items in that loss that our insured was going to incur. Out-of-pocket costs after deductible are never a really good thing when it comes to your insurance. You're hoping that they pick it up from there.
Was this a fire loss?
Yes.
Okay, so it sounds like they had a fire in one of the units. They probably, had a high deductible that they had to pay to begin with?
North of $5,000, yeah.
North of $5,000. But even after they paid their deductible, there wasn't really much money coming from the insurance company.
Yeah, let's say the cost to totally replace it might have been $50,000. I'm just using some numbers. Well, here's a check for $30,000. That doesn't feel very good.
So why was the check light from the insurance company?
Well, actual cash value is by definition replacement cost. Then they take away any depreciation. So on a building built in the 70s, there's a whole laundry list of things that could be depreciated: flooring, trim, walls, roof, mechanicals.
That's an important point. If you're insured for actual cash value, that doesn't mean they're going to pay you the value of what they're replacing. They're going to depreciate it over the period that it's been in place.
Yep. Replacement costs, take away all that depreciation, take away the deductible. Here's your check.
Replacement cost versus actual cash value. If you're insured for actual cash value, be prepared for that value to be depreciated if you ever have to file a claim. If you're insured for replacement cost value, you're probably going to pay a little bit more, but if you ever have to file a claim, they're just cutting you a check for the full amount.
You know what your deductible is. That's what you should keep around. You have a $5,000 deductible. That should pretty much be your out-of-pocket costs. There's a whole other list of things to consider, but that's the number one. Not knowing how your policy responds at claim time and that unknown out-of-pocket expense that can be extremely costly to the investor at claim time. What we really take a look at when we're sitting down is the organization of the policy, consistency with the coverage from locations 1, 2, 3, 4, 5, making sure that they all line up. You wouldn't believe when I look at a portfolio that has, let's say, 10 locations in it, you might have 4 or 5 different coverages, limits of liability, named insureds. The organization and the structure can be every bit as important as the replacement cost versus the actual cash value.
Why is it important that all that lines up?
Well, that first and foremost, the named insured on the policy and the owner of that building have to match.
If the policy is under my personal name, but the building is owned under my LLC, is that a problem?
Yeah. Insurable interest is really the key. You do not insure something you do not own. Making sure the named insured matches the building is key. And with an investor, you might have 4 or 5 different LLCs going on at one time. That's very common because that whole strategy of dividing and conquer to limit your liability is popular. And I don't claim to be an attorney, but knowing how you're organized and insuring properly can be very, very important.
How else have you seen these policies not line up? I mean, I can understand why it would be a problem if the name of the insured party is different from the name of the party that actually owns the property. But what else does not line up, or have you seen not line up?
Well, I'll go with a recent one. A lot of brand new investors out there, they might have getting into their first property or first several properties, and they still have them in their personal name. So Brian Hamrick would still have 2 or 3 units individually insured and owned in Brian Hamrick's name. Well, how are those properties coordinating with your actual personal insurance? Because now you're talking about personal umbrella liability, your personal homeowner's liability that can often be extended to these properties. So your personal insurance package, if you're just getting started, can be every bit as important to evaluate and make sure there are no gaps there as someone who has a large portfolio and they're more on the commercial side.
You definitely want to not have your rental properties in your personal name. That causes all kinds of problems. But
It's common. It's very common.
It's very common, but I've never thought about it from the insurance aspect. Because now you're kind of commingling your insurance position with your rental properties.
Right. Making sure that you have someone looking at the whole picture and evaluating where you might be exposed, either from your personal policies to your personal rental dwellings or your new investment portfolio. Those policies, if you're going to keep them in your personal name, they really do need to talk to one another and coordinate to make sure that you don't have an issue. So having someone look at not just one little slice or one little part of your account is important. Making sure that they evaluate the big picture ultimately can save dollars, increase value and coverage, and make sure you don't have those gaps.
Yeah. Now, I know when I started my buying of rental property in my portfolio, it was mainly single families out of state. And I did title those in my personal name. I was advised at the time to have an umbrella insurance policy to cover me in case everything went wrong. Is that still sound advice?
You can never have too much liability. People always ask, well, how much is enough? Well, if we were walking out of court and I could tell you the limit we needed, I would tell you. But liability is inexpensive peace of mind. Buy as much as you can afford. And it varies person to person, client to client, but I always recommend a personal umbrella. Whether that personal umbrella is covering a few rental properties, fine. If it's a commercial umbrella and it's covering LLC or a business entity, we write a separate commercial umbrella.
And just to educate everyone, an umbrella policy is what?
It's excess liability over and above your business insurance policy or your personal insurance policy. It's deep dollar liability protection for assets and your business.
So you also mentioned just lack of organization. Like if you have multiple policies with different agents or agencies, how can that lead to problems?
Well, when investors buy properties, they're buying, one property in 2014, another property in 2015. They're all over the place, and sometimes that has an effect on their insurance being all over the place because of when and where they were in their lives when they were buying these properties. But sitting down and having a big picture organization or a big picture view of their whole account can often consolidate, eliminate those coverage gaps, and help make sure that they're structured properly. So you might have an investor that has 4 different companies on 4 different properties. Well, all those companies have different coverage forms and different endorsements. You might have a different claim experience with every single one of them and different costs that might be incurred. So making sure that your coverage limits, your endorsements, and your companies are consistent oftentimes is a better way to go. Can lead to better pricing for the policyholder, but also significantly better coverage.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. So I know that in the case of our relationship, I have different insurance providers that you've brokered for me, different policies with different insurance providers. Is the difference there that you're kind of wrangling it all together and making sure that it's consistent across the board?
Yeah, well, and every company has a little bit different appetite for what they really specialize in. Well, if you have an older building, really old Grand Rapids building, as you know, the appetite for that building is very, very narrow. Not a lot of companies will touch it. But when you have properties in Wyoming that are built in the 70s, well, you have a lot more options. Making sure that we tailor that company to what the risk is or what the exposure is really important. But the key is having the same person looking at it with the same mentality, looking at the coverage limits, how the claims are settled, high liability, proper risk management. What can I take on as an investor? What can I afford to take a risk on? And where do I want to make sure I'm 100% covered on?
So I know when I first met with you about my insurance needs, we looked at a lot of different factors. You know, what's the cost of coverage versus what is the value of that coverage? It might help if we just take a step back. You tell us your personal philosophy on how you approach insurance and making sure that people are covered in the way they should be.
Yeah, the purpose of the insurance is to cover the large losses. We want to be that foundation so you don't incur any costs that can put you out of business. Proper risk management, high liability on the policy, referring back to the umbrella we just discussed, add umbrella coverage. You know, where as an investor can I afford to take on risk? And maybe that's with a higher deductible, and then buy that extra couple $1 million of liability or increase the property to replacement cost coverage. So my out-of-pocket at claim time is no longer an unknown, but a $10,000 deductible or a $5,000 deductible that, hey, I know I've got that. I'm on the hook for the first 5 or 10. After that, that's why I buy my insurance policy.
Right. So it's all about managing risk. In the cases of most of my properties, I believe I am insured at replacement value.
Replacement cost coverage, higher deductible, buying lots of liability because you know if it's going to be a claim that's smaller, or I call it the ticky-tack claim, something that's small, you're going to have your property manager go over there and take care of it. You're not going to be turning in small claims that can ultimately drive rate. You're going to manage it for the long haul to keep those premiums in line.
Yeah, very rarely, if ever, do we ever file an insurance claim. Just because if it's a small dollar amount and close to my deductible, there's no point in doing it.
No. And I think if we refer back to, I think we had a fire about 3 or 4 years ago.
Yes. Well, when we first took over one of the apartments, there was a fire in one of the units. Our deductible at that point was $25,000. Well, guess what it cost to do the
white box the unit.
White box the unit and bring it back online. It was right around $25,000.
$26,000. And you know what? As you can see, that philosophy has worked for us. Your long-term premiums have been trending down. Had you turned in, a small, in that case, for those of you out there, it's a large apartment community. So a $25,000 deductible might sound like a lot, but it's all to scale.
And I think we've since lowered that deductible somewhat.
Yep.
So you really have to weigh those factors.
Yeah, looking at your long-term experience with an insurance company is also a big part of your pricing.
So when it comes to making insurance claims, what's your take on that? I mean, how should people judge their risk there. Because if you do make a claim, you might get paid out, but it could increase the long-term cost of your insurance after that point.
Yeah, we're in business to pay claims, but a large claim to you might not be a large claim to somebody else. Everyone has their threshold for pain, so to speak. If I'm a brand new investor, I might not be able to afford $10,000 deductible. Maybe $1,000 fits me. If I have a pipe burst in my wall and it's a $5,000 claim, that's probably something you turn in as a brand new investor. You can't afford to take on that loss. Someone who's been in business, has a property manager, has a little excess on the side, and they've been in it for a while, might just take care of something like that. Everybody's different, but you can take what we're saying here about risk management and apply it to every situation, just on a different scale.
If you are thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition 5 years ago, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you're expecting a change in your healthcare insurance coverage for any reason, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
I'm reminded of the time when I lived in Santa Monica and I lived in a condo. I owned a condo there. Somehow I ended up becoming president of the HOA.
I know how that goes.
And I remember looking at our insurance policy and it was sky high. I couldn't understand why. And then we come to find out that someone had had a pipe burst in their wall and filed the insurance claim on their own behalf with our HOA insurance policy. They've been paid out $2,000, but our insurance policy went up way more than that every year. So you really have to weigh the cost of filing an insurance claim.
Yep. Having someone interview you as a client and say, where are you in your business? Where can you afford to take risk? Here's what I'm thinking. That personal contact and face-to-face meeting with your agent, at least on an annual basis, is key because it gets an idea of where you are in your business. You're constantly changing. It's not a static thing. It's more of a dynamic thing. How are we going to adapt from year to year to what's going on in your business?
And sometimes when you weigh that risk, you also have to look at the specific area in which you're investing. Now, I know that here in the Grand Rapids area, there are some changes that are happening when it comes to rents and insuring yourself against rent loss. Can you talk about that a little bit?
Yeah, Brian, how are rents going for you versus 2 or 3 years ago?
Rents have definitely increased. They've plateaued somewhat, but it's a very strong rental market right now.
Right. When I look at lost rent or business income coverage, most policies on an individual basis, so a personal lines rental policy is going to give you automatically 10% of your home value. So if your home's $100,000, you're going to have $10,000 of lost rents. Well, on most single-family homes right now, especially in Grand Rapids, I don't know, you tell me, Brian, $1,200 a month? $1,500 a month?
Yeah, I mean, it's probably higher depending on the quality of the property.
So that automatic 10%, that $10,000 on a $100,000 house I just described, you're well short of even 12 full months of lost rent. So on a fire loss, that doesn't, a 12-month period is not out of the question for rehabilitation on that house. You could have 2 or 3 months of investigation before you even tear the house down that you're losing money. And now you got to rebuild that property. So, I try to have at least 12 to 18 months worth of lost rent coverage as far as an insurable limit to make sure that landlord isn't going to be losing money, especially the new investor who has a mortgage that they have to pay.
Lost rent coverage, this is something you would talk to your insurance agent or broker about. In case there is a fire and people can't live there for 12 to 18 months, you want to still get that rent income.
Especially on a multi-unit building. You don't know how bad that's going to be, how many units are down, or even a single family. If it's sitting there, it's not generating revenue, and you still have to pay your bills, that loss of rent keeps you in business.
Yeah, it helps pay your mortgage because you still have to pay your mortgage.
It pays the mortgage. Mm-hmm. Yep. So yeah, having proper loss rent coverage is another area that I see, especially now in West Michigan where those rents are higher. You got to adjust it. So having someone look at monthly limits for lost rents, how long it's going to go, that's key.
What does that usually cost to add to an insurance policy?
I can't give a specific number, but it's very inexpensive. It's a detail, but it's an important detail.
Yeah, if you own rental property and you don't have loss of rent as part of your policy, you need to talk to your insurance agent.
Yep. And some guys out there who are very established choose to cut that out because they self-insure for things like that. But majority, I'd say 90% plus are looking at it or should be looking at it.
Yeah, and we're talking to
The majority.
here. What about investors or landlords who own rental property that they rent to students? I know that that's a very specific niche and it has specific insurance requirements.
Yeah, student rentals can be very profitable. I mean, colleges, universities all over Michigan, all over the United States, investors, that's a big part of their portfolio, and it can be very profitable. But oftentimes, they either start out as renting as single families and they convert to students, or they just start out as students and don't talk about it with their insurance provider, because most standard companies really shy away from the student rental market for liability reasons. They don't want that party atmosphere or the higher likelihood of loss.
So they feel that students are not mature enough to take care of the properties, or they're probably going to statistically pay out more on student rentals.
Exactly. So making sure your policy acknowledges that it is a student rental property is really key. I like to do when it comes to paying out an insurance claim, we want to deal in areas in black and white, not gray. That gray area. Well, I don't know if it's,
So where have you run into this problem?
In Grand Rapids specifically. I mean, think of how many colleges, universities we have within 10 miles of right where we're sitting. They're living somewhere. The investor's getting top dollar because they're oftentimes combining 3 or 4 unrelated individuals paying for the room. So you might be getting a premium rent, but taking a little bit of that extra rent and applying it to the proper insurance policy to make sure your liability is covered as a student rental and your property is covered as a student rental. Very key. That's a common mistake. People would rather bury their head in the sand on it and not deal with it until there's a large loss.
So give me an example then.
I won't pick on this company, but there's a company out there that seems to have a lot of student rentals, but there's nowhere on their policy or in their policy forms that say it's student liability or student rental. One of our companies has a program, they charge an extra 25% for it. Small price to pay to know it's properly insured. And they're actually going to pay or not non-renew the policy if there was a loss.
Right. And if there is a loss, what happens? What will the insurance companies say if they find out, well, wait a minute, we weren't insuring for students, but it turns out you have students here?
They could possibly deny coverage. Or they might pay that loss and then non-renew the account. Well, if you have a lot of accounts with that provider, now you have to answer it to the next provider. Hey, have you ever been canceled or non-renewed for underwriting reasons? Now it's a yes. Now you have more of an issue going forward trying to find that next provider who wants to take you on. So, being upfront about it, finding the right program might cost you a little bit more money, but what are you getting for your money? Making sure it's done right.
Protecting yourself against that additional risk.
Yeah, take a little bit of that extra rent, apply it to making sure it's done right. That'd be my advice.
Let's talk about flippers and rehabbers.
They're everywhere.
Yeah, they are. It's a big business still.
Yep.
So where are they making mistakes?
Well, that'd be another specialty line that most companies will not touch with a 10-foot pole. They don't want that. I guess they call them the attractive nuisance out there. They don't want the boarded up house or the home that's got nobody in it or is full of tools while it's being rehabbed. It's attractive to someone to break in or people to mess with the property. Having a market or a vacant under renovation policy is very important. Making sure that you communicate well with that insurance company, because a vacant policy can be voided out as soon as somebody moves in. So having a vacant provision is very important, but having it converted to a rental occupied policy as soon as you do have somebody is even more important. So communication, I stress on the vacant and the flippers, constantly communicating status updates, being in touch.
So if you're flipping or rehabbing, you need to be in communication with your agent.
Yeah, and oftentimes that rehab gets way more expensive than you anticipated. You dump in way more money because a vacant policy, you're only eligible for basic form coverage, meaning you're only insuring against fire, lightning, wind, internal explosion, the causes of loss. So you're not able to get all that replacement cost coverage, your actual cash value or the cost of what you're putting into the property plus the purchase price. So all of a sudden you get 6 months into a rehab and you're twice as much into it as you thought you were going to be. That's another phone call I'd be making.
Because you need to up the value of what you're insuring.
Absolutely.
Yeah, and that goes for any property. As you own it longer, you put a new roof on it, new water heater, you're adding value to that property. Maybe you refinance and it appraises for higher. you need to let your insurance agent know that, right?
Yeah, open communication. And that goes back to annual meetings, Brian. And there are so many, that's the number one thing I ask. When's the last time you saw your agent? When have you actually sat down and reviewed your coverage, not just talked about what your premiums are? Because the premiums are always going to change, but where's your business? What exposures do you have that you didn't tell me about since last year? How are rents in your area? Did you add an addition onto that building and now it's a 4-unit instead of a 3-unit? Those are common things I hear on a weekly basis that can affect how we insure the property.
Speaking of being in communication with your agent, I know that having gone through 2 refinances in the past year, you were heavily involved in those because there would be insurance questions that would come up, policy issues that needed to be addressed. You would just communicate directly with the lender that we were refinancing with to handle those.
Yeah, on a commercial, a large loan, those banks have specific requirements, and they can be very detailed. So you might have to have an extra $1 million of liability to work with that bank. Well, guess what? That costs money, and it costs time to go back and evaluate your policy, make sure that going through this process can actually not cost you too much to say, hey, I don't want to do it.
Banks and lenders have their requirements.
Yeah.
You have to meet them. So you have to have an insurance agent or broker who knows how to do that.
Yeah, and communication, open communication, talking, making sure that their requirements don't far exceed what you actually have, and you might actually write a new policy.
I want to go back to vacancies here because we were talking about flippers and rehabbers. But what about just people in the ordinary course of turning over units? If someone moves out, it's vacant for 1 or 2 months before they can get it turned and get a new tenant in there.
That's normal. 60 days is nothing to worry about. But a lot of times that time between tenants where the investor goes in and starts rehabbing a property to get it ready for the next tenant, or, hey, I've always wanted to do X, Y, and Z to my property. Now I have the opportunity. If you're more of a long-term vacancy where you're going to be putting time and money into the property, not just a normal turnover from tenant A to tenant B, I would communicate that to your agent because you might have to change the form on the policy, add some additional endorsements, or change companies altogether to get it properly covered during that period of time.
Stay in communication with
am I sounding like a broken record?
That's important. So here in Grand Rapids, we have a lot of historic districts, rental properties that are 100 years old. What are some of the specific things we need to keep in consideration for those properties when it comes to insurance?
Well, the term ordinance or law applies. You have a lot of these old properties that are grandfathered in to the old ordinance or law at the time they were built. And if there was a loss where we had to pull a building permit to be working on the property, now all those new zoning ordinance or laws or zoning issues could apply to the property. We had a client where, let's just say, a tree fell on the house, knocked out the electrical service coming into the home. Well, they had to pull a permit to update that service. Well, if there's not the proper ordinance or law coverage to be able to cover that, the insurance company says, okay, we're going to fix everything but what code is requiring. So having that ordinance or law and having the right limits, depending on where the property is, can be key.
So how would you cover yourself for that? If a tree falls on your 100-year-old property and now all of a sudden you have to redo the electric in the entire building, can you cover yourself with insurance on that?
Yeah, there's just the right endorsements for ordinance or law and picking the right limit.
So you called it an endorsement. So it's something that's tacked onto your insurance policy to say, hey, in this situation, you're covered.
Right. Let's go to an apartment building. Back when that was built, it didn't have an elevator in it, or it didn't comply with the ADA, America with Disabilities Act. Now, at the claim time, and you pull that permit, now you're going to have to comply with all those issues. You might have to add that elevator or that whole entrance point into the building to comply with the current city ordinance or laws. That costs a lot of money, especially on a large building. So making sure you're having that conversation or having someone tell you where you may be exposed could be definite cost saving at the end.
So when you meet with your clients or potential clients, you look at the age of their property. And
I go out and see every building.
You kind of take into account, all right, what are some of the things that might happen that you would want to insure for?
Getting out and actually walking around the property, taking a look at it, having a conversation, getting the inspection reports, those all go into having the proper insurance because those details make a big difference.
Yeah, what are some of the things you look for when you look at a property?
Oh, I look for things that my insurance companies are going to look for. Safety issues first, making sure that handrails are where they're supposed to be. Everything the city inspector's really looking for, the insurance underwriters are looking for too. that handrail where it's supposed to be, trip and fall hazards, maintenance issues, exterior appearance of buildings. There's their peeling, cracking paint. Is the siding hanging? Are they missing shingles on the front of the house? Are tree limbs hanging over it? Curb appeal things, all insurance companies look for and they all inspect.
So, Mike, I understand what you're saying about staying in communication with your agent or broker, managing your risk through the different, through the way you manage your policy and the different endorsements. But I'm sure a lot of people are thinking, okay, how do I accomplish all these things that Mike Murphy is telling me without my insurance premiums going sky high to cover them? So how do you manage those types of costs?
Going back to looking at everything, looking at how all your policies communicate with one another, getting those multi-policy credits. If we need to go to replacement costs from actual cash value, obviously you're going to be spending more in insurance because you're raising your limits. But maybe you raise your deductibles a little bit, have more value created in your policy. I'm getting more, I'm not paying more. Managing for the long term, the large loss, ultimately limits what your out-of-pocket could be to a known instead of an unknown.
Going off of what you just said, what did you call them?
Multi-policy credits,
multi-policy credits.
You might have a business auto policy, a commercial umbrella policy, a commercial package policy.
A life insurance policy.
Yes, exactly.
In my case, yeah, you had me get a life insurance policy so I could get a big discount on one of my properties.
Yeah, having someone look at all of your lines of business ultimately can pay off because getting more with the same carrier, they're going to give you more back in discounts. So getting more bang for your buck is always the term. Well, it really does apply because, if you get your commercial auto, your commercial umbrella, your commercial package on that apartment building or several homes with the same company, you're going to add more value, ultimately be able to purchase the right coverage and not break the bank.
You've always encouraged me to go for the replacement value coverage and have somewhat higher deductibles.
Yeah.
And that seems to have kept the yearly cost at a reasonable rate.
Yep. We're not turning in the small claims, which had you had a $1,000 deductible on these locations, you might have been tempted to. But knowing that deductible is at $10,000, you're not even going to look to your insurance provider unless it's that major issue, which is really what you're here for. We had a customer a year ago, fairly large investment portfolio, anything from single-family homes to a multifamily apartment buildings, where they were insured all on actual cash value based on 5 to 10 years ago when they bought these properties. Well, specifically talking to West Michigan, what's happened around here? Values are way up, right?
Absolutely. Yeah. I mean, way, way up from 10 years ago.
So when they bought the property, that might, the apartment building they bought for $250,000 might be worth significantly more now. Well, how do I make sure that I can actually replace what I'm getting? Well, we took a look at this portfolio, raised everything from actual cash value to replacement cost, but we didn't double their coverage. Or double their premium, we managed it with all the techniques we just described here, and we're actually able to get them a heck of a lot more coverage, liability and property coverage, filled a bunch of their holes, and ultimately didn't cost them, if anything, additional.
It sounds like what you're saying is that people shouldn't be scared to come to someone like yourself,
right,
and say, let's look at my policy and see where I'm undercovered, where I don't have enough coverage, where maybe the value that I'm covering it for is not enough, and what sort of pitfalls are out there that I'm not paying attention to.
Right. That goes back to a lack of basic understanding of where your money's going. Well, I'm buying these insurance policies and I have no understanding of how it's going to respond at claim time. Well, that's no good. You want to make sure you know the basics and have someone that's talking to you at least on an annual basis, how you can avoid some issues that we just described here today.
It may seem somewhat daunting because you might think, well, gee, it's going to cost me so much more to improve my coverage. The managing the coverage and the risk, you might actually be able to lower costs in some cases.
Yep, add value. Investors are always looking where they can add value. Well, this is a definite way to add value for the long term. Protect yourself.
So, Mike, as we wrap it up here, who should get in touch with you and how would they do so?
Well, anyone from the first-time investor to the established landlord who has a whole portfolio, if they haven't had that personal relationship or sat down with their agent in a while, it's a good opportunity to look at ways to add value and fill those holes in their coverage. I can be reached by phone or email. I'm local in Grand Rapids, service the whole West Michigan area. Our phone number is 616-868-0050 to set up an appointment, or we can do an email. It's Mike, M-I-K-E, M for Murphy, at jbhins.com.
And I'll make sure that's in the show notes as well.
Sure.
Well, Mike, I certainly appreciate you handling my insurance policies and all my residential properties.
Thanks.
It's definitely been a beneficial relationship, and you've done a great job adding value and just helping me out in so many different situations when it comes time to refinance and the bank is asking me for things I don't even understand what they want. I can just forward the email to you, and you're like, I got it. Don't worry about it.
Yep. Well, thank you. Yeah, no, I appreciate it.
Yeah, and I want to thank you, too, for becoming a new sponsor on the show.
Excited. Yep.
Yeah, I'm excited to have you. I highly recommend your services. It's good to have an insurance broker who isn't just going to shuttle you into one type of policy, but has multiple policies and providers to choose between.
We like to pride ourselves on giving our customers choices, providing that personal service, and really going out and sitting down eyeball to eyeball. A little old-fashioned nowadays. Nobody really likes to take the time, but 20, 30 minutes can save you a lot of time and money in the future.
And you always take the time, and I appreciate it. Thank you for being here.
Hey, thanks, Brian.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.